today.
Okay, it's 20th of December. Welcome to the weekly update of what I believe is the best core holding you should have for the next 10 years. And if you're new, your first time, welcome. Hope you get something out of this. So my point is there's an opportunity coming up, which is this commodity cycle. So back to the 1800s, we have ups and downs, and here we are here. So why not participate in it? Why diversify across asset classes, countries, blah, 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 and end up just getting an average, 10% per annum, or for Australia, 4% this year. Get into the commodities, and I'll run through all these different sectors and show, just how what's happening, and we're just starting. So what we've got here is the commodity index. This is a live chart of this here, made up of a basket of different commodity packages, and you can see we're just starting in this game. Now, so this guy is referred to as the tank, if you're new. So just to go through who he is, so it's the MVR ETF, basically all our big miners, 31 of them. BHP, Woodside, 7%. So it's not terribly overweighted, and as we go through the list, the weightings get smaller. So it's a nice mix. So this is, and this date here, 4th of August, becomes important for our benchmarking exercises. So I'll just go back to a weekly chart. So the tank's been, since he became the tank, he's up 25%. I've had some feedback from people who have gone through the conversion therapy. Like a subscriber here this week, I was into VAS and VGS IVV. You are the one who changed my direction completely, Rudy. I'm so glad that I found your channel. So that's, I'm not trying to sell you a brokerage account or anything like that. Just trying to get you in the right space. Okay, so that's him. Now, a lot of people get the old, VAS VGS, that's what you want. So this is VAS, and like all share markets, they all go from left to right up, but they go up in various rates. And then the other one's VGS, that's the other common combo. The VAS VGS again goes up. But the thing is, I like to use ratios. So you take the chart of VGS over VAS, and it shows you, if we do this little calculation here, so that from there to there is 60%. So basically, VGS outperformed VAS by 60% since 2015. So if you just invested all in VGS, you'd have 60% more money. Yes, VAS pays a little bit more dividends than VGS, but not significant. Okay, so you should have been not invested in VAS. All right, and then we have the NDQ. Now, this is what I mean by themes, because the last 10 years it's been tech. And you can see, again, left to right, it goes up. But if you had have invested all your money in the NASDAQ instead of VGS, he'd be up, that's 95%. So you're getting the gist that why diversify Diversified when, you know, tech was going to be a big thing. Now going forward, do I think tech's going to be a big thing? Well, we're going to this AI thing, and tech companies are going to burn money trying to win the race, and not all of them are going to win. But this new tech world needs a lot of energy, which is resources. One, so oil, gas, copper for electric wires and cables, blah blah. Okay, so there you go. You should have been invested in the Nasdaq. Okay, so now we've got a ratio MVR over VAS. So again, we do the ratio. So if the 4th of August, you had it switched, that's why the 4th of August, because that's when he became the tank, when he started outperforming VAS. So you'd be up 25% if you did the switch. And do I believe that will go on? Yes. So why? Why, Rudy? So this is the XMJ, which is an index, not an ETF, but it's a proxy. And just to prove, I'm not making it up. So that's MVR, and that's XMJ. So you can see, because MVR doesn't have the history. Okay, so this is a proxy for MVR, where you can see back in the 2000s we had this big run, and now we're about to break out. And you can think, oh geez, we've already run pretty hard, really, compared to that run. But if we make this chart logarithmic, which means this is now in percentage moves, not units, you can see the percentage move there compared to there is, we're only just beginning the party. And if we use the XMJ over XKO, is basically VAS. So you can see back here, outperformed the general Australian share market, and we're now going to start to outperform again. Okay, so now we're looking at the NASDAQ index, because it's got a lot of history there. You can see that's been a pretty pretty good run. So if we compare the XMJ over NASDAQ, so you can see here you didn't want to be invested in resources. You wanted to be, because NASDAQ kicked its ass. Look at that, it's been kicking its ass, and it's only now the tide. You can see this is, well, if you're new, you'll get to learn these declining wedges when broken are bullish. So you can see here we're just starting this breakout of the resources against the tech sector. Okay, so hopefully that all makes sense. Or even if you're in all that stuff as VGS, switch half of it or whatever. I'm just trying to help you make money. So another ratio, MVR over IVV. So again, outperforming. MVR over VGS, outperforming. We've got this new Macquarie ETF. Well, their best 200 and 500 best global companies. MVR outperforming. VDGR. So this is an interesting side topic. So this is basically the same as a growth option in Australian Super Diversified Index. Because a number of people have Australian Super and Host Plus, you can buy ASX. You can't buy MVR, but you can buy mining stocks to replicate it. So you can see MVR's been outperforming that. MVR over Qual outperforming. MVR over VDHG outperforming. But then if you're new, we've got this concept of ninja ETFs. So these are sector-specific resource ETFs. One of my favourite ninjas is ETP Mag, which is silver. can see been and you can actually buy this in Oz Super. And if we look at, this is MVR over ETP mag, so the tank has not been outperforming. He's actually underperformed by 30%. So the tank's the boring one, and then we have ninjas for the exciting stuff. And if we see ETP mag over the NASDAQ, so if you had to switch from the NASDAQ back here, you'd be up 60%. So this has already started outperforming. The tank's just beginning. Okay. So hopefully all that makes sense. So now we'll go through the holdings and the commodity charts so you can get a feel and see that these commodity prices are breaking out. So we start with copper. So you can see here, copper's now just breaking out 2020, so 5 years. Iron ore, not expecting it to do big things, but it's bullish and holding in there. We're low cost miners. So we look at them because BHP, so that's the biggest holding. So it's just, there's your declining wedge breaking out. So it mines basically copper and iron ore. Now oil, so for existing subscribers, we've been watching this. So we'll just take a long-term picture of it. So oil used to have one of these, and now it's just been hammered, you could say. But we're potentially at a bottom now. We're looking at a 1 hour chart. So for existing subscribers, they'll be happy because of the next stock we're about to look at. So it looks like oil has found a bottom. Natural gas trying to find some support here. So that flows through to this guy, Woodside, second biggest holding in the tank. So he's now, we've had 1, 2, I went early there. So he's now going to get this week an official buy signal, which will be good for the tank. Gold. So if we take the long term, you can see gold's just on a tear. Government's printing money. Gold's real money. If you don't know the story, you'll get to learn it along the journey. So gold's tapping on the all-time highs. So the miner there, we've got this Northern Star. So it's just waiting for gold to break out. And we've got Fortescue, iron ore miner. There's that declining wedge break, so it'll make its way up. Then we've got aluminium, and you can see breaking out. So that float Rio. So they're iron ore, aluminium, copper. So you can see they've now just broken out and on their way. Then we've got zinc breaking out. Got lead, hasn't broken out yet, but finding support. And then my girlfriend, if you're new, you'll understand if you keep watching. So silver's this $50 level since 1980, only just recently broken out. And so on Friday, all-time highs. So that's the ETP mag ETF, this one. So we look at that because South 32, they're involved in aluminium, zinc and lead and a little bit of silver. But you can see here declining wedge, they're about to break out. Then we've got Evolution, they're copper gold, so they're about to break out. And we've got Origin, so they're, they sell electricity and they got some gas operations, so they're coming. So oil and gas, so now these things will start going, and hopefully If I had a choice, I wouldn't have Santos. I'd just have more Woodside. But anyway, it's an ETF. You can't pick your family. Like your cousin you don't like, he's still your cousin. Anyway, Orica. So they're mining explosives. So they're going up. Ramelius, a gold producer. Okay, lithium. So you can see lithium was right up here and got hammered. It's now breaking out. So that goes through to Pilbara Minerals. So there's that declining wedge break. So it's nearly basically doubled in price since July. Linus, the rare earths. That was when Trump and China, rare earth issues, and then it all went away, and now they're getting hammered, but they'll find a bottom around here. Worley, global engineering, they're not doing very good because they went and backed the green energy scam, and they're losing money from those projects, like most people will. Ampol, looking fine. Perseus, so they're a gold producer. Okay, then we've got coal. So thermal coal hasn't broken out yet. I still think there'll be a lot of demand for coal going forward. Solar and windmills don't provide base load energy. Anyway, so Whitehaven Coal, so they're obviously a coal producer. Mineral Resources, so they're a bit of iron ore, lithium and mining services. There's your declining wedge break. Genesis, so they're a gold producer. Capricorn, gold producer. Sandfire, copper. Horizon, rail freight, declining wedge break. So all these charts look pretty good, really, don't they? Dino Label, so they're in the explosive business as well. So they're breaking out. Regis, gold producer. Liontown, so lithium. Okay, uranium. So uranium spot price, so for existing subscribers, that's another breakout happening. So in the tank we got Playdon. So there's your declining wedge break up. Monadelphous, mining services. Aluka, they're another sort of rare earth play. So they'll find a bottom around here. IGO, so they're lithium, they're breaking out. Then we got Beach, oil and gas, they're becoming a buy now. And then lastly, the Terra royalties, iron ore, just iron ore royalties basically. So they're all the underlying stocks of the tank. So now we do the portfolio construction. Okay, putting the portfolio together by Rooster Productions. Okay, so how I see it is think of it, it's a war game. So the objective is to destroy the enemy who live in the castle, and they've got riches in the castle. So the first decision is what type of attack will I do. That basically depends on, do I want the riches in the castle? So basically if you say yes you want the riches, then you're saying you want high growth. If you don't want the riches, just means you want income with a bit of growth above inflation. Okay. Alright, so you decided you want the riches. So the plan of attack, you're going to need a tank to destroy the castle, and then some ninjas to go and steal the riches. Okay. Alright, so the tank is MVR, so he just sits in the background there and drops his bombs, throws his missiles into the castle. so he doesn't get his hands dirty really, but he does good hard chunk of it. And then you're going to need some ninjas. So these ninjas do a dangerous job, obviously, because they're going into the castle. So there's two types of ninjas. There's ASX ninjas. So there's ETFs like XMET, which is a sort of, it's got a whole lot of copper, rare earths, lithium, silver miners in there. It's not bad. Uranium miners, your gold miners, your silver ETF, your copper miners, your small companies ETF, like a defense tech ETF, or any of your own growth ideas or shares that you might have. Then we've got some special US based ninjas. So these are which you can't get on the ASX. So these guys do a bit more of a powerful job than the ASX ones. So we've got your rare earth ETF, a uranium ETF, but these are the large caps. These are the medium cap uranium miners. SilJ, which is your silver miners. You get a little bit of them in XMET. GDXJ, which is your mid-tier gold producers. Miners is your senior gold producers. So in a bull market, the mediums outpace the seniors. So that's why I say they've got special growth powers. And LitP, which is a lithium ETF. You get a bit of lithium in there, but you get more depth. So in here, for example, in XMET, you might get 1 or 2 companies in lithium, whereas in here you get about 30. Okay, all right. So what percent of tank and ninjas should I use? All right. Well, so ultimate risk, like game on. I'll take anything. Alright, then you just go with no tank and just ninjas. Okay, you just go all in. So it can be done. I do have a subscriber who's done the just ninjas, and he in his first month he got a bit nervous because it dropped 10% in a week. Now he's laughing, but ninjas do a dangerous job. So if you're going to have ninja, you're going to expect, a week one of those ninjas could drop 10% in a week. Let's just set that. That's how dangerous the job is. But in a bull market, I expect them to come back like that sub did. He was in Remex, the rare earth one. Now he's up about 30 or 40%. Or you can go medium risk, okay? So that would be a 50-50 job, 50 tank, 50 ninjas. Or you can go low risk, but not low risk as in cash, but that would be just the tank. But I'm still, when you go the tank, I'm still expecting the tank to outperform VAS, VGS, IVV. So it's not, it's not low risk like in the bank. There's still volatility, but the tank isn't going to drop 10% in a week. Okay, so you've got to sort of work out your risk profile there. I don't want to be given personal advice around, what. The rooster, I'll get in trouble from the rooster. He's my compliance officer. All right, or you decided, okay, I don't want the riches. I've got enough money. I don't need to make 30-40% in a year. I'm just exaggerating, but these ninjas I expect to make at least 10-20% per annum. A lot of them are up all that in 6 months. But it's nothing's guaranteed. It's a dangerous job. You get reward for the risk you take. All right, so you're still going to need a tank to destroy the castle, because you can't. You got to do some work, but you're going to need some drinking buddies. Just sit in the tank with you. So your drinking buddies are like your VHY, SYI, so dividend ETFs, ASX 300 div shares, or property trusts. Okay, so in this scenario, what percent of tank and drinking buddies? Well, I'm thinking, like, if you're on ultimate income, then you go like 30% tank, because the tank's going to pay you a 4% div. So you can put that in the bank. And then say 70% drinking buddies, who'll pay you, I don't know, 6%. So that you still got you could just have drinking buddies, but they'll drink too much and they won't do any work. So the tanks, the growth performance of the tank will outperform the drinking buddies. Okay, because the tank's going to outperform VAS, and VAS is sort of the banks and your drinking buddies. Okay, so all right, or you want a good income but a bit of extra growth. So you set the bench, say 50% tank and 50% drinking buddies. All right, so that's just a framework. And each weekend I go through, do a video on the dividend shares and ETFs, and I do a video on all the ninjas. All right, hope you enjoyed that. Let us know your thoughts. See ya.